Welcome back to Good Day Orlando. In the Consumer Corner, the first few years of retirement are a perfect time to explore your passions, travel the world, bond with your family. Something else they can be great for too, cutting your lifetime tax bill while keeping more of your own hard-earned money. Certified financial planner Gary Abely joining us this morning to explain how to lower your taxes in retirement. Gary, good morning. Nice to see you.
Good morning. Nice to see you.
Well, let's get started. I know a lot of people are trying to sock as much money away as they can, and you've got some advice when it comes to, let's say, the first 5 years of retirement, really.
I do, and it could be even a little bit longer depending on when somebody does retire. Best way to go over it is in an example. I just had somebody at our office. They retired at age 65, started on Medicare, and they were saying, you know, I've really got myself in a great situation. I'm not paying any taxes at all. And we looked at their accounts and retirement accounts and realized that they were going to defer until age 70, Social Security, which is a good thing.
Is that standard? A lot of people choose to do that?
A lot of people do. Okay. You get about an 8% bump per year, so it's a nice strategy. But in this particular case, they were celebrating something that I said they should be weeping over. Ooh. And that is because they had zero taxable income. And for a married filing joint, between your standard deduction and your personal exemptions, that's about $20,000. And then the next $75,000, so now we're up to $95,000, is taxed at only 15%. And of course, there's a portion that's taxed at 10%. So when I said to this individual, I said, you know that we could have converted $95,000 of your regular IRA into a Roth IRA, which would then have yielded a $400,000 at a 7% growth rate account, completely tax-free in your mid-80s. And guess what? We can do this at year 66, 67, 68, 69, and 70 until you start Social Security. Now, once he starts Social Security and has to start taking required minimum distributions from that IRA or 401k, it doesn't work anymore because now he's going to be up in a higher bracket. But a lot of people celebrate paying no taxes in those early years in retirement, and that's the exact opposite of what you want to do in some cases.
So in layman's terms, when you're looking specifically at this case, how much money would he be saving, or how much money would he be gaining by doing what you had advised him to do?
Well, if he did it over the 5-year period of time, it could be a tax savings as much as $250,000.
Oh my gosh.
But even better, if he was able to maybe not use all of that Roth IRA, his children would be able to inherit that money completely tax-free because it would be a Roth rather than inheriting an IRA, which would be taxable. So it would benefit even the next generation.
Okay, so switch to a Roth, get ahead of the IRS, and sell some stock.
Well, yes, sell some stock, because a lot of people don't realize that if you're in the 15% tax bracket or lower, and that you don't have to be retired, this is good for anybody, you pay no income taxes on that long-term capital gain. So as long as you've held it for at least a year, the tax is zero, so why wouldn't you sell some stock? Now, if you're in love with the stock, there are strategies we can help people to get back into the stock after they sell it, recognize the gain, and pay zero taxes on it. So those are two great strategies.
Okay, we got to make our money last as long as we can.
We do,
right?
yes. Keep it from the IRS.
Where can people find you?
They can find us at financialgroup.com.
All right, very good. All right, we're also